So friends, once again, good morning. Happy to have you all here. And like I said, just throw in whatever questions you have as you like. I mean, put it on the chat box. And if you really need to ask at that point of time, then by all means, feel free to interrupt me. We're just going to go through everything that's happening around us. So if I start counting, I run short of fingers. There's so many problems that are going around all across, right? Uh, High interest rates, which is happening in America, it's happening in our country also. Everyone is getting hassled with that. Our interest cost is sort of moving up. The home loan EMIs are taking longer to get paid off. The tenure is increasing. So interest rate is one, of course, huge problem. Having said that, we are seeing a lot of layoffs happening. We see it in the newspaper, Facebook, and Tesla and Twitter, and all these companies have made huge layoffs. But 2 days back, our own newspapers also carried that Infosys and Wipro has also been laying off people. Today morning's paper has also carried something around that. So very quietly, those layoffs are still going on. And some of you from the technology industry probably know it for even a closer quarter, but feel free to add any information that you have on that. Uh, it seems that the demand for the technology products are sort of going down a little bit. And I'm not sure if that is exactly true, but this is what the media says. But on the other hand, if you look at it, there was a time in COVID and post-COVID where a lot of people lost jobs. Then a lot of recruitment was done in 2021, by the hundreds of thousands. And obviously, maybe there is excess capacity now, which is why we are seeing all of that happen. Then very recently, we heard about Silicon Valley Bank going down. We heard about Credit Suisse going down. But see, if you think about all of this is actually only related to interest rates. So बहुत simple है. जब पैसा महंगा हो जाता है, तो we start cutting down as individuals. We start cutting down because our budgets go up. As a country, as an economy, there are other kind of problems that an economy has. Lesser people borrow, corporates borrow lesser. Whatever they have borrowed is becoming more expensive, so on and so forth. So it's just exactly the same relationship. But high interest rates is generally after a point very, very, very dangerous for any sort of a system. And this is normal. So we hear some banks going down. Of course, we've thankfully not seen any fraud of that magnitude, which has happened in SVB or even for that matter, Credit Suisse. But, bond trading goes for a toss, and as a result of which some banks kind of fall. Sometimes even this is a little bit of a signal of sorts, that the bad times are kind of ending. So high interest rates happen from time to time. I'm not putting too many pictures right now to show the graph, but there is a phase in which interest rates rise for a period, then they sort of stabilize, and then they start tapering off again. And when the tapering starts happening, then again, we are in a better situation. We've already had announcements from America which have come, which is very clear. They're saying that there might be one more rate hike. And after that, in 2024, the tapering will start and the rate hikes will start moving down. So, which is absolutely, sort of good news for us in that sense. We in India also don't expect too much of a rate hike to happen. This time it was stable, the last rate hike. And see, it's important to talk about it because, what happens is, in a very simple term again, when the rate goes higher, when a fixed deposit goes from 7% to 8%, a lot of people get motivated to go and invest there because now they're getting 8 and then maybe 8.25 and then 8.50. So what happens is it's like a magnet of sorts, So when the interest rate goes up, like a magnet, it just sucks away all the money from everywhere else, and everybody wants to get into that because they want that assurance and guarantee. And that's how we as human beings have always operated. Wherever we see guarantee, we tend to gravitate towards that. But then when they start going down, then we find not so much of an incentive to hang around there. And which is why we sort of come out and, then we start looking at alternative places to invest and doing things like that. So that's broadly what is happening. What's happening in India? India is very, very robust. The chances of recession are zero, right from WhatsApp messages that have been circulating to everything that is happening around the world. We've seen everything. We have continuously seen the fact that, in India, chances of recession is zero. Our GDP is rising every month after month. We are hitting the higher and higher levels of GST collection. And India as an economy seems to be in a very, very robust sort of a position. So nothing seems to be wrong here. And I think that's absolutely great news. It's really time to take a big long call on India. Of course, there are some negatives also that happened in the month of February and March. with the adverse taxation that got levied on insurance products and on bond funds and debt mutual funds that we have. So while we were enjoying that, I think the government is very, very clear that they want to try and get tax from whichever area tax is available. So from wherever it's possible, they want to get this tax revenue up, because there's only those many people, right? You might be sort of surprised to know that we are having in India about 7 crore returns that are filed annually approximately. And out of that, 90% of returns that are filed are below 10, 11 lakhs of income. So you can imagine that there is about 90% of people who are below that level filing income, which means there's only 10%, 60, 70 odd lakh people who file income tax returns which are greater than 10 to 12 lakhs of income per year. And they are the ones who are paying this tax, which is approximately about 6 lakh crores in the country. And the government as such has only that much limited revenue. So they want to do everything possibly that they can to try and make sure that they increase their revenues. But anyway, we take tax in our stride, and that's broadly what is happening around us. Let me just quickly show you a few things, in terms of what do we think in terms of what the market is going to look like? What's the market trend looking like, in the very, very immediate term, in the very short term, and in the very, slightly medium to long term. Okay, so I'm going to show you something very interesting here. Can you all see this graph? There, give me a check if you can. Yeah, okay, thank you. Okay, what you are seeing here is Nifty in the last 1 year. Okay, we've had independent conversations around this with a lot of you, but again, this is just to show that where you see my cursor is, this is somewhere about October 21, and today we are here in about April of 23. So as you can see, let me sort of zoom this further for you so that you can see it better. So you see, this point here was somewhere in March of 2023. Don't worry too much about what you see in terms of colors, just follow my cursor. That will give you a reasonably good understanding of what and how, as analysts, what we do and what we work, what other professional analysts do, so that you get a sense of what's happening. So this is where somewhere we were on towards the end of March. And then what you see, obviously you can see these green little tick marks or candles, as we call them, going up. What that means is from the last week of March to now, we have kind of moved up almost about 10% or so. If I was to take an absolute measurement tool and give you an analysis, as on day before yesterday was a market close day. The market is up about 6%. Individually, we've sent a lot of messages out to a lot of you. Portfolios that we have all, the stock portfolios especially, have all moved up about 10, 11%, 12% in this March period. So this is what's happening in the very, very short term. So in the next 1 or 2 months, sometimes we like to know what's the market looking like. So the market is looking good. The market is looking bullish, because when it goes down and when a reversal, when this kind of a V happens, then it means that, we are going to go up. And we are continuing to go up. But how long will we go up? Now that question is answered by a little bit more deeper analysis. So now if you take a view, say from 1 to 2 months to maybe 5 or 6 months, what are we like sort of looking at? Or maybe even the next 1, 2, 3 months. Let's say from now till about June, in the next 2 or 3 months, what do we look at? So now I've just put a little diagram over this. Just stay with me. I'm just moving this 5 around, okay? Because we don't know where the 5 is going to go. We know that this happened. See, markets move up in waves, right? It does not move up in one steady direction like a rocket, nor it falls like a rocket or like a wall down. But it moves in some sort of, wave kind of a format. So we are here. This is about June of 22. We went up, we came down, went up, came down. I mean, we've been struggling. The last 1 year, the markets have just been very, very choppy and volatile, as we call in our language. But they've just basically gone nowhere. They've just gone up and down and just hovered around the same place. So now, where will this number 5 happen? We are, like I said, immediately it seems like we are moving up. In the next 1 to 3 months, what do we think it can happen? Maybe we can go a little bit up to this point. Maybe we can go up to this point, which is not more than, maybe 200, 300, 400 points on the Nifty, and which is about not more than 1,000 or 1,500 on the Sensex. Okay. We could even sort of go here, and after that, we could even sort of go here, right? These other geometrical lines that you see, this green and this red and this red, it just basically gives us a sense of, when the market is falling, where is it likely to fall? So a lot of times when we are asked questions like, what do you think of the market in the next 1 or 2 years? So now nobody's, if we knew really the most accurate answer to that, then we would probably be running and laughing our ways to the banks with our own billions and millions of dollars. We wouldn't even need to do anything. But it's, a little bit of science, a little bit of guess, a little bit of analysis, and a little bit of reliance on the fact that history keeps repeating itself. So, what you see here is a chart. This chart is nothing but it's an expression of human behavior, or a collective human behavior, or what people are thinking collectively, and that's what we call as a market, right? So we get some sort of an indication that, we probably will be here next 1 or 2 months, just to summarize, we'll be probably here, maybe in the next 1 year, or, we could even go here. I mean, even that's a possibility. So the frank answer that, what's going to happen in the next 1 or 2 months, we're very clear, we're moving up. What will happen in the next 3 to 6 months? Actually, don't know. Nobody knows. I mean, anything could happen. We could be circulating. I mean, we have this whole area, and this is known as an area of uncertainty. We don't know what's going to happen. Okay. So we stick to that. But then that's not how we ordinarily invest, right? We ordinarily invest from a slightly longer time frame. So what is India looking like, or what's the view looking like on a slightly long term? And for that, I'm going to show a different diagram. Okay. Can you see this little chart on your screen again? Now, this is a very beautiful, very interesting chart. And this is the Holy Bible. This is the gospel. This is like everything. This is what can even make you an expert at figuring out what the trend is and how we are likely to move where. Okay. What you see in this dark line, the black line here is nothing but the Nifty index. And the red line that you see is the P ratio. P ratio is also in a very simple format known as how expensive or cheap is the market. So naturally, if the P ratio is high, the market is expensive. If the P ratio is low, the market is cheap. And that is what we can see. Now, if you see, this is what you're seeing here on your screen is a view from almost the year 2002. 2002 is here. You can't see it on your screen, but I know that this is 2002. And it's going all the way till 22. So it's a 20-year chart that you have on your screen. If you observe a little closely, what you will see is, this market is doing whatever it's doing. It's sort of doing these ups and downs. But this red line is kind of more or less mapping the market. It's kind of following it, if you see. So here, if the market came down, this P also came down. Here, the market sort of went up, in the upward direction. The P also started moving up. And more or less, it's, as you can see, it's kind of riding along with the market, right? So if the market was going up here, you can see the P is also sort of going up. Don't mind my drawing, but anyway, this is a drawing from a mouse. So anyway, the market went down here. The P also sort of went down. Can you see? It's kind of following. It's kind of corroborating, right? And now see, this was COVID, okay? This period here, I mean, this little fall was COVID, and markets fell. Obviously, the P ratio also fell, which means the market fell, and at this level, it became super, super cheap, right? And after that, we saw a huge rally happening. This is obviously October 21 on the market, and this is basically where we are. I mean, which is again very, very interesting, isn't it? So if you think about it, we are, it seems, at a very, very interesting sort of a level. Okay, so the Nifty PE here, the PE ratio is at about 20. Can you see right now? I think I made a mistake. The red line is the Nifty and the black line is the PE. Okay, my apologies, friends. But anyway, the essence is this. So the Nifty is here and the P ratio is here. This tells me something very interesting. At this point, we were at the lowest possible, and look at the rally that we saw. This is a low point. This is a low point. Expected rally, huge. This was a low point. See what happened after that. Look at this low point. See, typically this is the scale on which the PE is. So the PE is 16, and here this band is 24. So at this level, if the PE was, then we saw a huge rally. When the PE went so low, I mean, it was like sell everything you have and get into the market. And then the market basically gave us a great rally. So these are things that are happening right now. I thought of sharing this thing with you because, like I said, this is our holy gospel. We are at a PE of 20, which means we are super cheap. So if you ask me what is going to happen in the next 6 to 12 months, maybe 2 years, maybe 3 years, I think we will touch some different orbits of the market. We are at about 20,000 Nifty, which means about 60,000 on the Sensex. So where we will land up, uh, I don't want to hazard a guess, but way back in November, we did a little bit of a session where we said that the market is likely to be at 2 lakh Sensex by 2030. So I think we are well on track. Not only that, the government actually came around and said that, maybe by about 2026, 27, the market is going to show you some enormous growth because the economy is going to become $5 trillion by 26, 27. So which I think is absolutely, again, astonishing, amazing. So essentially, we are in for like a fantastic ride, right? So having said that, let's sort of move on. You get a sense of the market. So far, is it good? Guys, if you all can just let me know on the chat also, or otherwise you can just unmute. So far, is it going all right? I mean, does it make sense? Are you with me in terms of what I'm saying, or is there something that anyone of you didn't follow? Please unmute or yourself, or yeah, okay, or just give me a thumbs up or okay or whatever. So I know that everything's.
One question, Kartik. The graphs you showed about PE and Nifty. I
Yes,
mean,
yes.
it looks like the last couple of years there is a huge divergence between the two graphs. I mean, the red one is going up, which is Nifty, I believe, and PE is dropping a lot. Whereas, so this is a unique situation. Like,
Absolutely right. Here you can see it, isn't it? So actually, it's not been too much of time. If you see this point here was Feb 15, 2021. So technically, it's about 2 years. So in 2 years,
yes,
what has happened is this is the red line is the market, right? See, that's what I've been saying. A lot of our portfolios haven't seen too much of a return in the last period ensuing last 18 months or so. And I've said this a number of times also that sometimes the market does have a habit of giving these kind of flat periods. So market's gone nowhere, up and down, up and down. But the P has fallen. I'm glad you asked. Sorry, I can't see who asked this question, but
Vivek.
Vivek, huh? So Vivek, thanks. Yeah, I'm so glad you asked this thing because there's a very important point I want to make, and for the benefit of everyone. See, markets didn't go anywhere. Okay, everyone just pay absolute attention to what I'm saying. The markets did not go anywhere, but the P has fallen dramatically. Now, what is P? P stands for price as the numerator, and E stands for the earnings of the companies as the denominator. So when does the P ratio fall? If this is, let me sort of just write it down for the benefit. This is P divided by E, right? Simple mathematics of fifth standard, right? And whatever this ratio is, today this ratio is equal to 20, okay, as a number. Now, if it was 40, and if it had to go down to 20, what would have to happen? The numerator would have to go up, or the denominator would have to come, the numerator would have to come down, or the denominator would have to go up. What has happened to the numerator? It's been steady. Nothing has happened to the market. The market has just been steady right from this point. If you see, market has done nothing. It's just gone up, down, up, down, up, down, more or less. वहीं पे खड़ा है. कुछ नहीं किया उसने. But that means what? The earnings have gone up, which is what I just said a while ago. Corporate India is doing fabulous. Chances of recession in India is zero. Profits are going through the roof. Companies are doing fabulous. Now, whether now or whether 6 months down the line or 1 year down the line, you will see an explosive rally because the P has come down to its 20-year average, if you see. And that means the earnings have really shot through the roof. Everybody is doing extremely well. Each company is doing well. I'm sure increments are happening beautifully for everybody in terms of salaries and in terms of earnings, even if you are self-employed. So economy is robust, thriving, and firing on all cylinders. And therefore, I think we are absolutely very, very convinced about the fact that things are moving. I'm going to take a few stocks, just to show you, exactly what I mean. Going further, so in terms of market trend, we've understood where we are. Okay, after market trend, we'll just very quickly, I'll just tell you which are the sectors that are looking most promising. Okay, This is just for information. By the way, there's no recommendation coming in to buy or sell. I mean, I have to say this thing from a compliance point of view also. This is purely only for educational. Everything that we're talking is just education and information, but no specific buy or sell recommendation. Uh, so energy, FMCG, auto, finance, realty also looking nice. I don't know how, but this is purely on the charts that it is looking very, very positive. And like I said, chart is nothing but a reflection of human behavior and emotion. And that obviously is triggered by the balance sheet or triggered by fundamentally. If something is good, then I will want to buy it. It's very simple. If I find that iPhone 14 is a fabulous device versus an iPhone 7 or 8, then I want to buy it. It's basically a human psychology. So there's the same thing that is going to play. Is this making sense? Is this enjoyable?
Yes, Kartik, this is Anand. It's making sense and giving me hope. That's all I can say.
Giving you
No, but from a data standpoint, I know what you're talking about. I know you keep saying that it will happen. Now I'm seeing why you keep saying that.
Yeah, exactly.
Thank you for this.
Yeah, and you know what happens? Sometimes the markets have their own method. They don't react and they don't respond to us the way we would like to respond. But the fact is the data is there in front of us, and data is God. And I mean, your technology industry, right? So, data is technology. I'm sorry, data is God today. That technology has the power to change everything. And we are only talking what we see in terms of data. Does it make sense? Did it give you a little bit of insight as to what we do every day of our 252 stock market working days of the year? Now we are moving to the second part of what we wanted to discuss and talk with you about. I mean, the topic of the day, which was basically having these free holidays for life. What we also want to highlight with this topic is it's very straightforward, right? You have money, and that money basically earns more money, and you, as a result of which, can have these free holidays to life. But it's an adaptation of financial planning. So when we talk about free holidays for life, or basically assume that there's this huge pot of money that we've created. We've been investing money monthly, annually. We are deploying money, and we are making this huge pot, right? This massive pot of money which is there. And let's assume this pot has a little tap towards the bottom of it. So just the way you have water from a water fountain or a water filter, there's enough water in that canister, but you only need a glass today. So you sort of open the canister and let a glass of water pour out, enjoy that glass. If you want another one, help yourself. And then you let the pot, stay as it is. The only beautiful thing is that you just have to refill the pot with whatever you are doing, okay, which is your capital. But the market is also showering, and there is rainfall happening, and sometimes there are cloud bursts also that happen in this kind of a corpus. Well, sometimes there is a little bit of bullets also that come and hit this canister, and you suddenly have leakages from everywhere. But then those bullets get plugged very, very quickly. Just talking in a lighter kind of format, but essentially the idea is that monthly, annually, we deploy some amount of money, make a corpus. From that corpus, we have a little bit of opening of the tap, as I would like to call it, and we withdraw whatever we get at the end of the year annually. And there might be years in which there'll be extra surplus as well. So I'm actually going to ask Jhaveri to just show us the tool, and he's going to just simulate it, and then I'll be also speaking with him. But it's a very, very powerful way of how we can plan. And this tool is going to be available to you. We'll just email it and we'll just share it with everybody, so you can also do it at your leisure. But Jhaveri, can you just take over and take us through that tool? I'll stop my share. Okay, go on. And please unmute yourself also. Yeah. We can't hear you. Can you unmute yourself, please?
Can you hear me now?
Yes, we can hear you.
Okay. So yeah, so the pot that we are talking about, and just what Kartik sir mentioned. So we are trying to simulate something which we want to do very, very quickly and very easily, right? So here we are trying to illustrate a fact that if you want to take a holiday from like next year itself for life, that is what we are trying to achieve. It is still going to be possible with a little bit of an investment. So if you look at this simulation, and basically you just need to put in a few numbers here. So based on the age of the person, so we have just taken a random 33 kind of an age. So you can just shift this across whatever your age may be, maybe 35, 40, 45. Okay. And what we are trying to say is that from next year, if you want to take like a holiday for the next 30 years, and mind you, this amount is obviously going to increase. So we are basically saying that you increase the amount. I mean, obviously we have just taken a random number of 1 lakh from next year for the next few years, and then going upwards by about 50,000 each year. And what we want to also say is that the future value, obviously taking a little bit of an inflation as well, considered about 6%. Okay. What's it going to be like maybe say 10 years, 20 years down the line? So say, for example, if you want to take a holiday like maybe in 2035, and you have budgeted about say 2 lakhs in the current scenario, you might still be needing about 4 lakhs in terms of value at that point of time, assuming a 6% inflation, which is like about 12 years down the line, essentially. So that is what we are trying to give you. So, and this can still be achieved. So basically what it's saying is that if you put in like a lump sum investment or like a monthly investment as well, this still can be achieved maybe 12 years down the line. So right now, if you put in like a lakh of rupees aside, okay, 12 years down the line, you will still be able to take this holiday, even if it's at about 4 lakhs. And if you do like a monthly, even like a 1200 kind of figure, then that is still achievable, more or less, assuming that we are growing that money at about 12%.
So basically, we are saying that you can take whatever assumption you want. 12% is a fair assumption to take, and you take the assumption as 6% inflation. Sorry, Jhaveri, I just wanted to say that.
Yeah. So, so what we are also what we are trying to get at is, if you look at the overall number, so to say, so you will probably create a holiday fund by putting in a little bit of money aside. So we can assume that if you're creating a pot like about 2.5 crores across maybe the next 30 years, okay, then we can still possibly take a holiday like every year for the next 30 years. And this is just basically either assuming that you either put aside about 50,000 like as an SIP monthly, or if you have like a lump sum of about 30 odd lakhs, then you put that money aside. And what we do is essentially we create that pot of about 2.5 crores over the next 30 years, which will take care of all the holidays across the next 30 years, essentially. So this is anyways, as in when you want, you can obviously change the numbers. We have just taken an assumption of you taking a holiday basically every year from the next year itself. Okay. But so there are two things. This is like a steady increment kind of year on year. And this is just another way of looking at, maybe if we want to plot in a specific holiday, maybe 5 years down the line, you can also do that. And the same estimates can be calculated based on where you want to take the holiday and based on what your current age is, basically. So these are just some tools that we want to share with you so that you also can work out basically whatever you want to invest and create that kind of a corpus that you can use to achieve this kind of a number.
Okay, thanks, Harish. Just unmute everybody. So, let me just quickly summarize what he said. So yellow cells is data entry, very simple. When you use this tool yourself, this is just like a kind of a concept, this timeline steady, this particular sheet, just to drive the concept, just to clear the concept and explain, because it's easier to see steady numbers instead of seeing numbers going all over the place. But very simple, take an assumed rate of return of 12, take an inflation of 6, both are fairly good numbers to work with. And why 12%, I'll tell you that in just a moment, but for now, just stay with me, take it as 12, look at 6% inflation. So what's going to happen is you just have to go and in these yellow cells, put whatever number you want. Suppose you want to take a holiday to America, family of 4, after 10 years, example. So after 10 years, today, what would it cost you? Let us say today, if you're going to America, family of 4, maybe it's going to cost you 5 lakhs a person. So say 20 lakhs. Then, but I really want to go after 10 years. So somewhere around here, I will just put a figure of 20 lakhs. And the rest of it will all get calculated for you automatically. So just for this particular holiday, there it is already calculated. Jhaveri has just done that. So he's saying 10 years later, this 20 lakhs will actually cost 36 lakhs. Uske liye today you need to have 11,53,000, or you need to do a 15,400 rupees ka SIP, something of that sort. It's just as simple as that. Let me just sort of mark this thing again, just to draw your attention on this. This is how this particular tool works. Now, this is what we do for planning one little goal. But here we have given the facility of weekend holidays, domestic holidays, weekend breaks, the national holidays, whatever you want, however you want. Just estimate, have a fun Sunday, tomorrow if you like, and start filling up all these yellow numbers as you like. Once you do that, you just have to fill up. Age is also just for your reference. Okay, it's just a number, doesn't matter. Zari, revert back on this one, change this back to where it was. And what happens is then you just put in whatever number you want in the yellow cell. It will calculate what is the current amount of money that you need or you need to invest. So now here it says to have this sort of a cash flow, the way we have written it, you need to totally, your funding requirement is going to be 2 crores and 43 lakhs 90,000, whatever, say 2.5 crores for simplicity. But how much do you need today to invest? You just need to invest 28 lakhs, or you need to do a SIP of 46, or the portfolio that we already have, we can earmark a part of that and do replanning in this new format, where we say that, okay, out of the existing fund, let's earmark 28 lakhs for this. I mean, just taking an example again, and this is going to be our holiday fund. So we switch the thing, we suggest to make the product change, the strategy change, and as a result of which, then your pot is already ready. All you have to do is open the tap and enjoy yourself year after year. See, it's easy. Now, if I were to ask you a question, for a moment, can you stop the share, please? If I were to ask you a question that, Zari, can you stop the share? So if I were to ask you a question for just a small little moment, next year you want to go for a holiday. And if you want to go for a holiday next year, and if you have to make a budget of, let's say, 4 lakhs for something, do you immediately, and if I told you that, I'll give you a discount, and you have to pay me, I'll give you like an amazing 15% discount, which means I'll charge you 60,000 less, but pay me 3.5 lakhs like today, right now. Suppose I'm the travel agent, okay, and this is what I'm coming and telling you. One would think, yeah, where am I going to take out this 3.5 from? I mean, being with us, most of you don't have money in the bank. Most of you don't have too much of cash balances because we don't believe in having so much of cash balance, right? We invest the money, whether it's a debt fund or whether it's an equity fund, but we invest everything everywhere, correct? So the point is, where will you take out? But this is our case. But let's say your friends and family, is everybody in a position to pull out the money just like that? Suppose 3 years down the lane, and we say, okay, we want to do a US holiday, we need 20 lakhs. Do we have the money to instantly pull it out? It's just a matter of putting things into perspective and creating a discipline out of our own corpus. So we have a fund, we have a little pot, we put a label on it. This is the label. This is my holiday fund. Once that is done, problem solved. Whatever you need, whenever you want, just open the tap, take out the money. Okay. Now let's talk about the 12%. Why we assumed a 12% growth. See, what do we need? We need a product here, which is obviously, a good performer, but more than good performer here, we are not interested so much desperately in performance that it has to be number one in terms of performance. It has to be the best mutual fund. This has to be, by the way, done from a mutual fund. Can't be done from a portfolio of stocks because of some other challenges, which we will not get into. because you don't know which stock to sell and what to sell at what point of time, because that strategy is different, so on and so forth. But a fund is very easy. Jhaveri, can you show me some funds, some sample funds that we have chosen, which will deliver what we are talking about? Okay, now here I want to show you something very interesting. What you see here, like I said, we don't want huge performance, right? We don't want the best performer. The word that we have to focus on is consistent performer. We want somebody who is consistently giving us returns. Now, what you see on your screen is, again, this is from Value Research, public data available. You can see it yourself. So nothing is something which is privy to us, but we've of course chosen the funds based on a little bit of other factors like standard deviation and alpha and all of that also. But having said that, these years that you see, right, 2013, 14, 15, I'm just taking you through this very slowly. If you lose me somewhere, just sort of give me a signal. Tejasvi, please watch the chats if somebody has said something on the chat, because while I'm speaking, I'm not looking at the chat. So if somebody's made any related comment on this, please have a look at that. Okay, thanks. So look at, these are calendar years. Okay, these are not financial years. Please note, very important. You get this annual analysis also. As you can see, this is annual. Okay. Now, in this annual analysis, what this Canara Robeco fund did in the year 2013, which is from January to December, it gave a return of 4%, as you can see. Okay. In 14, it did 45%, 6%, 3%, 25, 1, 11, 19, whatever. All right. Now, we were looking for a 12% return, and I said consistency. Correct. So my need has got fulfilled here in 22, in 20. 1167 is almost equal to 12. So let us say 19 also, 17 also, 14 also. So out of this last 10-year period, my requirement of getting 12% plus got done once, twice, thrice, 4, and 5 times. Has it done negative in any year? No. See, that's also important. We don't want to go down. Here in 2015, it did a 6%. Well, 6% not so bad, right? But what I would have done is, in 2014, I needed only 12% returns, remember here? And I had an extra surplus of 33%. I could take out this extra surplus at the end of December, take it out and park it somewhere else, park it into a fixed deposit or park it into a debt fund, or just move the money out of this. Now this 6, I can, out of this 33, I can fund the shortage here, and I can also fund the shortage here, correct? So here I had a shortage of 6%, here I had a shortage of 9%. So 6 plus 9, 15% shortage I had in the next 2 years, which can easily be funded from the 33% here. And in the meanwhile, while these 2 years are going to happen in future, I'm also going to earn some interest. Of course, tax to bharna padega, but I'm going to earn some interest also on this 33. See, it's a way of thinking, it's a way of looking at it. And these funds have been basically chosen on the basis of very few zero returns. Like this particular Kotak fund is got, out of the 10 years, it's got 0 returns here, -6 in just 1 year. Otherwise, all the years positive returns, and the year in which you have a little excess return, we'll sort of fund the future years there. So let's say if we were in this Kotak fund, this particular 2015 return was only 2%, but then we have got, and we just needed 12 out of this. So 28 minus 12, we have a surplus of 16. So this 16 can be used very nicely in 2015, and 2016 we were at almost 11%. We are home, not a problem. Then in 2017 we earned 24%, which takes care of this year plus this year, and so on and so forth. The story goes on. 14, 15, 28, and then 28 will fund the year of 22. See, 22 has been a very challenging year, right? We would all agree, whether it's funds, whether it's stocks. 22 has been a bit of a challenging year. 23 hopefully will not be, because that's also, by the way, another clue of what to expect in this year. This year will be good because you don't have a simultaneous bad year. Very rare. Like this particular fund, 2 years of bad performance, rare. But otherwise, this is just our experience of studying data and history for the last so many years. You don't have 2 years of consecutive negative returns from a fund point of view, because they're professionals doing it. But fir bhi kabhi bhi ho jata hai. So you can't really hold that against them. But having said that, look at the consistency of this Kotak fund. Yeah, very nice. We also are liking Mirai fund. 8, 27, 1, 27, 11, 13, 23, 26. Now, if you start comparing this fund, I must also warn. So this is value research, right? When you compare these funds with equity funds, you might see that the other equity funds are way ahead in terms of performance. But like I said, consistency. And by the way, here's the most important thing to observe about this fund: hybrid, hybrid, hybrid. What this hybrid means is that out of the 100 rupees that is invested in this type of a fund, approximately only 65% money goes into equity market. Okay, 35% of the money stays in fixed income, or what we also call as debt. Okay, so which means 1/3 of your portfolio is always stable. It's always going to earn that 5, 6, 7, 8%, depending on what the interest rate is in the country. So let's say 6% safely for the next 10 years. Okay, so this is 1/3 of the portfolio will keep earning the 6% through and through. It is this 65 which will, make great returns also, have negative returns also, and have flat returns also. But the way the professionals of these funds and the fund managers tend to manage these funds is try and give us a reasonably smooth experience. So we don't see too much of ups and downs. We don't see too many negative years. And if we are going to use this kind of a fund to fund our holidays, then we can be pretty much assured that today, whatever be the market condition, if we put money into this fund, we are going to be good. Can you remove the screen share, please? Right. So there we are. So whatever be the market condition, these kind of funds can deliver our objective of funding holidays for the next so many years. So the tool is there to play around. Once you've gone through the tool and you made a little bit of a planning, we can of course sit with you, do a quick Zoom call or meet in person and plug these numbers in, and then we can have like a budget ready for us. So for the ones who are going to start, or the funds who, if you're going to recommend to somebody who does not know us or who doesn't know anything about what we do, this is a great way to even recommend that these guys create a holiday fund. And in this particular fund, what can happen is you don't have to invest, for so many years. And then, like typically we say, the first you invest for 5, 10, 15 years, and then you'll be able to take out money, and then you'll be, able to have that apple from the, tree of life and that kind of a thing. Here, you're going to get to pull out and withdraw the money in 12 months. And 12 months also, becomes long-term from a tax point of view in a equity mutual fund. So which means the tax that will happen will be a 10% tax. It's not going to be an obnoxious 30% tax or whatever you are going to earn in a fixed deposit or something like that. So typically, this is what we do. We keep the money in a fixed deposit thinking it is safe. We'll earn 7%, and unfortunately, we will lose about 30-35% of that as tax. And we'll end up with about 4.5% thinking our money is safe. It's not even beating inflation. So why not consider these kind of hybrid as a much better idea? It does the 11-12%. It delivers that consistently. Very few 0 years, or actually no 0 years. Of course, can't be guaranteed, but it's a compelling thing to consider. Of course, holidays is one great way to use this as a vehicle. But even otherwise, if we wanted a consistent return, a senior citizen, all those kind of people can also use these hybrid funds. It's these hybrid funds because it's a great investment tool, consistent, smooth experience of returns. So that's what it does. So with that, this is what we wanted to share with you in this little quick 1-hour capsule for this month of April. We will hopefully again see you in May. But of course, before we go, Jhaveri, you can stop the recording right now. But we are here with you to answer anything that you may have. Nothing on your portfolio specific, because you could be in a short-term equity strategy. We may have bought Bank of Baroda. We may have sold it. We'll buy it again because that's a short-term strategy. In the long term, we will buy it and we'll keep it like that for many years together. I mean, just clarifying things. But let's just talk generally in terms of holidays, a concept, or stocks, or anything else that you would like to share. Please unmute everybody.